Egypt's plans to build a new $45 billion capital just east of Cairo in the next 7 years have run into a bit of a snag. It'll be about the size of Singapore, with an airport, if everything goes according to plan, larger than Heathrow. But we've run into a combination of funding plans, and remember, this is not the first time the efforts have been made to actually build an entirely new capital. We'll be seeing what went wrong this time round. Welcome to Global Business Africa. Here's what's coming up. The Mining on Top Africa conference starts in London. We'll have an update on talks and deliberations and deals there. And we'll be looking at a shot in the arm for Egyptian lantern makers who just cannot keep up with demand. Now then, let's start up north in Egypt. Plans to build a multi-billion-dollar capital east of the current one, Cairo, now hang in the balance. That's because of a dispute with an Emirati businessman. Local media reports that Egypt has cancelled its memorandum of understanding with an Emirati businessman, Mohammed Al Abba. But Egypt's investment minister, Ashraf Salman, insists the deal is still on. Abba is a tycoon who constructed the world's tallest building, the Burj Khalifa in Dubai, and he was to run this Egyptian project as well. Reportedly, he'd promised to help in attracting about $5.9 million required for the first phase. That, however, hasn't happened yet. Further, negotiations between Egypt and the UAE have not been conclusive over Egypt's insistence on foreign funding away from Egyptian banks. Now then, let's head over live to Cairo. Yasser Kim joins us now live from the Egyptian capital. The total figure for this entire project is absolutely large. $45 billion is plenty of money by any measure. Why is it that Mr. Abba has not been able to attract the capital in question?
Well, first of all, he was supposed to be the one, as a foreign investor, to bring the money from abroad. And with such a big amount comes high risks. And according to the policies and expectations from the Egyptian leadership is that the Gulf countries have promised to go ahead and take the risk and invest a lot of cash in Egypt in this time. Obviously, this did not happen, and he even tried to get funding from local banks, and the Egyptian president and the government refused, saying that the whole idea was to bring in cash from abroad, not from local banks or from the Egyptian market. And so loans from Egyptian banks have not worked out for him. So will he be able in the next few weeks to try to shore up some amount from outside? He's not said that he will do anyway.
Indeed. Walk us through the cash or equity portion that Egypt's government is supposed to put into this plan. And given what has happened so far, can this project proceed without any private sector investment at all?
Now, the government was not supposed to insert any much cash into it, but actually providing all the infrastructure for this huge project. And it's already started. The government is not waiting for the deal to be signed. It's already started the infrastructure projects, and it's working very hard, saying that it's going on track even before the deadline to get it ready. In return, around 40%, we've been told, is the share by the Egyptian government, which is another issue that Al Abba is, we're told, he's refusing. He's saying this is too much, 40%. He needs to reduce that amount, and also not to be partners in the company, but only the Egyptian government would take a section of the profits. As for the alternative, we're also been told that the government is working on alternatives now if Al Abba pulls out. And that is trying first either get the funding like it did from the Suez Canal with bonds in the market, and Egyptians would fund this huge project like it's done with the new Suez Canal project that will be inaugurated in a month. Or it will seek the Egyptian constructors and developers to take the role of Al Abba, but not one developer like they did with the UAE, but probably 4 or 5 of the biggest developers in Egypt. They have talked to them, and they are discussing now this issue.
Indeed. One last question for you, Yasser. This isn't the first time there have been efforts made to build an entirely new capital in Egypt. What's the difference in this? Well, let's not call it a failure. Let's call it a setback. What's the difference between this latest setback compared to those that have plagued past plans?
Yes, I'm glad you said a setback, because we're still waiting for a deal either to be signed or pulled out, or confirmation. But it happened during Sadat's time, and he wanted to do the same, but he chose a location and he called it Sadat City, which is too far away from the downtown, the main Cairo, and he did not offer the proper infrastructure and transportation. So he built the houses, he built the whole construction of houses, offices, government installations, but no one went there. All employees refused to go, and it was like a ghost town. And simply because it did not provide the infrastructure like schools and railway and transportation and so forth. And it's still there until now, but not well occupied, not well inhabited. Mubarak also started to study the idea, but he turned back on it, saying it's too expensive and the country cannot afford such a huge project now. They're trying to solve the same problems this time around, and they are tackling these same problems. They're preparing the infrastructure, but the big issue was that they agreed and they made a propaganda and they announced it before even striking a deal and contract with the company that they have the memorandum of understanding with. So they probably announced it before even they took the second step before the first step. They should have done the feasibility study, got the agreements, and then announced that all the details of the project and that it is going on. Now they don't know what to do. They're waiting for the UAE or trying to find alternatives.
Indeed. We'll leave it there for the time being. Thank you for your input. That's Yasser Hakim live there in Cairo. Now, African government officials and mining stakeholders, they're meeting in London for the Mining on Top Africa-London Summit. This meeting focuses on a range of issues: regulation, revenue sharing, project delivery, and ways in which Africa can further develop its mining potential. The event will also feature country-specific presentations from countries that usually you don't think about when you talk about mining, like Kenya, to those that you do when you think about mining, like Ghana, Cote d'Ivoire, Cameroon, Malawi and Mauritania. Africa is destined to have a strategic role as a global mineral supplier, given its vast amount of as and yet untapped resources. However, political and economic instability, problems with a lack of infrastructure and local capacity challenges to continue to hinder growth in that sector. Now, most sectors of South Africa's mining industry do remain under pressure. Last week, the gold sector entered wage talks, and this is set to add to the commodity's volatility. Angelo Coppola spoke to Roger Baxter, CEO of South Africa's Chamber of Mines, about this and other issues plaguing the industry.
One of the key issues facing the sector is black economic empowerment. The Department of Mineral Resources is pushing for BEE ownership structures to be current, while the Chamber is keen on a once empowered, always empowered approach. It's heading to the courts.
So it's not that the government and industry are fighting over a big issue. We've jointly agreed that we actually need to have an engagement through a court process to get certainty on an issue where both of us disagree on the interpretation.
Wage negotiations are always adversarial when unions and management attempt to find common ground. And then factor in that some 30% of the gold mining sector is loss-making, according to the Chamber, and the tensions will increase.
We are taking the view that commodity prices are going to be lower for longer, and we need to work within that sphere, and that means productivity improvement, cost cutting, and the critical necessity of pragmatic wage negotiations, because strike activity is just going to be more damaging.
Well, there's a huge risk for the metal engineering industry in that we've had our own strikes in the last few years. A big NUMSA strike last year, and also the platinum strike, which impacted the industry severely. If there's another big strike in terms of the negotiations in the mining industry, this will further cripple the industry. So we are hoping to a speedy solution to those deliberations and those negotiations, because the risk downstream for our industry is huge.
These are short-term issues, but the industry is thinking further ahead. Project Bahisa is a long-term project.
This is a unique opportunity for the sector stakeholders to work closely together, make sure that all the identified bottlenecks are properly accounted for, and that we really focus on the 3-foot plans.
The mining sector in South Africa employs around 500,000 people, and the spin-off is many times that number, probably 5 or 6 times, in terms of looking after members of the communities that these miners come from and have to go back to when they're finished with their shifts or when they're finished and going back on holiday. The bottom line is that it's an industry that is adding huge amounts of value to the South African economy, and it seems to be in a good state of health. I'm Angelo Coppola for CCTV in Johannesburg.
Let's get a bit more detail here from on that mining conference in London from Richard Bestick, who joins us now live from there. Richard, just exactly how pivotal is this forum in getting more investment for the African nations that are attending it?
Well, it's certainly come, this conference, at a time of crisis in the mining and metals industry. If you look at the figures, the London metals market has seen a crash in prices over the last 3 months that's brought them down to about the level of the financial crash of 2008. So there's no doubting that there is a need for some kind of thinking. This conference in London, though, is very much more along the lines of various representatives of the industry, of politics, of ministers from African nations, and of course of the African Union, really establishing between themselves how they view the state of the industry. And there are differing views, but clearly money is needed, and the industry itself needs some kind of investment.
Indeed, but you imagine there's quite a bit of competition here for the dwindling amount of available capital to go into these limited potential investment opportunities, aren't there?
It is, in a way. Let's say that there is a demand there, certainly, for investment, and it is needed. It's needed in a number of areas. In infrastructure, for example, to stop brownouts, for roads to carry the commodities overland to port so that they can be delivered to customers. But I was speaking to HSBC Bank today. They are saying that they are cautious about investing in exactly the same way as the owners and managers of mines are cautious about taking the loans. Basically, it's a cyclical market. It's at the bottom at the moment, and what HSBC was saying to me at this conference today is that neither the mines want to borrow the money at a time when profits are slim, and neither are banks particularly keen to lend.
Indeed, and nasty feedback loop building up there. Let's talk about regulatory and industrial stability. These have been significant concerns for potential investors, especially given the downturn rather in commodity prices. Is there a feeling perhaps that investment is only going to fall even further?
Investment probably can't fall much further. It's pretty much, depending on who you talk to at the conference, at its lowest level in a number of years. But I think you've hit it on the head when you talk about regulation. What the mining industry says it wants at the conference is it wants financial and political stability, because they say they have to make their assessments, make their judgments for investment into these hugely expensive projects over a number of years. What they don't want to see, they say, are sudden changes in tax regimes. They don't want to see sudden changes in policy if new governments come in. And they want to see that political stability maintained throughout. The African Union representative there today was saying, well, Africa is coming along in that way. But that's the essence of this, Raja, that's the essence of this conference, that ideas like this can be exchanged without causing offence.
Indeed. We'll leave it there for the time being. Thank you for your input. That's Richard Bestick live in London. Let's make a quick run through the markets here for you. Fairly interesting set of numbers coming through from across the board. The Kenyan bourse still essentially treading water, up by just about a tenth. Of interest, however, is the fact that the Kenyan government, a shareholder in the country's biggest single sugar miller, Mumia Sugar, has now offered the company a $10 million lifeline. Remember, of course, that this specific company has been badly run, has been making losses, and it's still operating in a fairly protected market. Should be interesting to see how this latest case of government intervention plays out lower down the line. We'll be looking at the task ahead for Nigeria's new president as he seeks to restore financial order. And we'll have a conversation with DHL's Managing Director for Africa coming up next.
This report by the African Green Revolution Alliance says climate change will slash food output. Within the next 30 years, the number of malnourished people in sub-Saharan Africa could jump nearly 40%.
Welcome back to the program. Now then, if you've watched this program regularly, you would know, based on our reporting, that Nigeria is in, to put it mildly, dire financial straits. States in that country are broke. Several of them obtained loans from the domestic bond market and banks when oil prices were high and boom times are still rolling out. But now that oil prices have plunged and revenues have fallen, they're exposed, and some have even unpaid salaries. Andrew Thompson has the details.
Nigeria's president has vowed to recover billions of dollars allegedly stolen by officials and restore financial sanity in the country. 36 states are in debt to the tune of $3.3 billion, and governors say they need federal government support to offset a funding crisis.
The lifestyle of the governors, the lifestyle of their children, of their family, is not synonymous with what the workers are going through. So there is a deception here. Bogus and false salaries in the name of security votes, in the name of Esther Code, are being collected by the governor and their cronies and their families, and they plunge their states into poverty and misery, and then turn around to be complaining. I don't think that Nigerians should give any sympathy to the governors.
The Naira currency has fallen sharply despite the central bank spending billions of dollars to try to prop it up. Gross revenues distributable to the three tiers of government, federal, state and local, hit a 5-year low in April due to frequent shutdowns of oil and depressed prices.
There is so much money in the hands of private individuals. This money should come out. The president should match his word with action by recovering all the loot of Abacha family, of Jonathan family, of any family that is guilty of taking the commonwealth of our people.
Nigerians want to see missing money recovered, but have also challenged state governments to find ways to boost their own revenues.
The governors have not been proactive enough. If you look at our states, all around we have natural resources. But it's been a thing that they always run into the federal government to get funds. And they are so used to that. And I want to say they are lazy. Because if they are not lazy, if they look around their state, there should be things to develop to make money. And it's not every time you run to the federal government, the center.
According to a statement released by the presidency, a committee headed by the vice president will look at how to use the excess crude account as a lifeline for states that owe salaries. Details of Nigeria's economic and financial position are expected to be published within 4 weeks. Andrew Thompson, CCTV.
On to Zimbabwe now. The central bank-owned asset management company has bought up to $100 million in bad debt from local banks. The company was set up in August last year to try and restore semblance of viability to the financial sector. Farai Makutuya has been looking at the cleanup.
Non-performing loans were hovering at about $750 million and had restricted issuing of fresh loans. It had also threatened the viability of industry players. At least 5 banks have gone under in the last 2 years over solvency issues. $100 million in debt bought will prop up the balance sheet of local banks and can immediately be injected back into the market, providing some relief from a crippling cash shortage.
In a country that is facing liquidity constraints, probably that could be statistically significant. It's a positive signal, and I think it's something that it goes some way, and probably we need to build on that momentum.
That will entail ensuring a repeat of the same untenable situation does not happen.
Obviously, need to address the structural issues that are affecting return on investment, that are affecting the viability of businesses. We need to go to the root of some of those issues. Okay. Some of the other issues are to do with the cost of finance itself. In Zimbabwe, obviously, when there are liquidity shortages, it affects the cost of money.
Interest rates here are as high as 25%. Banks blame this on failure to get cheap international credit lines because of the country's high-risk profile. The punitive interest rates have hampered recapitalization of the country's industries, many of which are in need of modern equipment. That in turn has affected their competitiveness, locking them out of lucrative export markets and putting them under pressure back home from cheap imports. Farai Makutuya, CCTV, Harare, Zimbabwe.
Now then, let's talk about logistics, specifically from the perspective of DHL. It considers East Africa, and Kenya particularly, a key region for growth within the wider sub-Saharan African region. The Managing Director for Sub-Saharan Africa, Charles Brewer, says the company's growth projections for the region mirror those of the IMF, a forecast of GDP growth of 6.9% for Kenya this year. DHL has operated in every African country and territory over the last 37 years. Now, Mr. Brewer was in Nairobi a little earlier. We spoke and when I asked him about the company's optimism in the continent. Our conversation started by asking him, what's the fastest growing market for DHL?
The fastest growing markets are the ones with the largest population and the biggest growing disposable incomes. So places like Ethiopia, Nigeria, Ghana, and then you've got some newer sort of what we call fire starters, places like Rwanda, Uganda, Kenya is still doing very, very well obviously, Mauritius. So a lot of countries growing real fast, some with a few more sort of issues this year than perhaps last, but generally speaking Africa's still very, very positive.
But within the context of the wider DHL operations, could you give us a sense of just what contribution Africa makes to the company's overall revenue?
Yeah, I mean DHL Africa is relatively small in the comparison to sort of Americas, Asia Pacific, Europe, and to a lesser degree Middle East. But it's a fast-growing region, and I think Deutsche Post DHL and DHL Express recognise that Africa is quite clearly the last frontier of significant growth over the next 5-10 years. So today, relatively small, performing very well. But everything we're doing now is really building for tomorrow and the expectation that we see over the next sort of 5, 10, 15 years.
Right. Moving on though, let's talk about the business split. I mean, what percentage of your traffic is coming from businesses and what percentage of that is entirely personal?
Africa is very different to the more traditional markets that we operate in, and DHL operates in more than 220 countries worldwide, and very typically in those markets we have something like a 60-40, 70-30 split between sort of the larger multinationals and what we would call B2C or H2H, transient ad hoc type shippers. Africa is significantly different. We have significantly less multinationals across Africa, but therefore the ad hoc market, the smaller, the cash business if you like, is significantly bigger, which calls for a different strategy, but one that we enjoy.
And that of course also does extend to your bottom line, because when you're talking about logistics planning, then that would essentially mean perhaps you need to focus more on vehicular traffic within and between urban centres, as opposed perhaps to a lot more aviation moving goods from point A to point B across different countries, doesn't it?
Well, it's, as I said, much like sort of the differences with our customer base, the footprint, the infrastructure, again, is very, very different to other markets that we operate in. So, again, across Africa, for the most part, we have to fly. So we operate our own aircraft across Africa. In fact, the only operator to do so. And that has positive and negatives. I mean, it's positive in as much that we create a lot of connectivity where there wouldn't be otherwise. But logistics, and again, well-touted number, logistics typically in Africa is between 6 and 9 times more expensive than it is elsewhere because of that.
One last question for you. It would be a shame if I didn't ask you this while you're still here. What is the strangest cargo that DHL has had to carry across Africa?
One is a chap who lives in Malawi, and he's particularly keen on English Indian food, so curries from England. And so every week he orders in his curry from his favourite restaurant in London and has it delivered by DHL. Why he can't get it locally, I have no idea.
And that, trust me, was not the only strange cargo that DHL does carry. Quick run through other things, however, that are not ferried around by DHL. Oil specifically. Crude price is still lingering in the low 60s, and that supply situation is supposed to actually get a little worse in future. Nigeria is putting in a little more cargo into the market, up for sale from July and August as well. So it should be interesting to see exactly how depressed prices will be moving forward. Now, Muslims in Egypt, they continue with their fast during the holy month of Ramadan. A key activity in this season is the buying of lanterns. However, in April, the Egyptian government banned the importation of handicrafts, and that included lanterns, ostensibly to boost local production of such items. Lindy Mtongana now reports on how they're coping.
As Muslims continue fasting during the month of Ramadan, there is usually a rise in demand for lanterns. Lanterns, or fanus as they are locally known, are an enduring part of the festivities. The tradition goes back thousands of years, and some say Ramadan is not complete without the lanterns. In previous years, many of the lanterns were imported, mainly from China.
I bought an Egyptian production of lanterns, although quality is not good, because I could not find the kind made in China. I really support the Egyptian product if it's changed for the better. It should also be as the quality of imported products and the same price.
Although the Egyptian lanterns are used to decorate, some can easily hurt the child.
Egyptians preferring imported lanterns got authorities worried that traditional lantern making and Egyptian artisanship could be compromised. The government decided to ban importation of handicrafts, including the lanterns. Egyptian artisans now dominate the lantern market, but many feel there is still need for variety.
Your quality is more better than us. Our stuff didn't have any competition with your stuff, because your machines is very special machines which make the stuff. We don't have these machines in Egypt, but we try to do something by ourselves. That's all.
I want to see a variety of products with a competitive market. I suggest that China and Egypt could become a partner, or let the plant opening a branch here train the Egyptian workers. Such a cooperation will create a new product.
The ban also aims at protecting the country's historical and cultural value as exhibited in its indigenous products. Lindy Mtongana, CCTV.
Right, then a quick run through currencies here for you. The Kenyan shilling, of course, still hovering under 99 shillings to the dollar. For how long, however, it can maintain that position is an entirely different matter altogether. Most of the fundamentals, of course, are firmly against that, set on a long-term trend of decline for the Kenyan shilling against the dollar. Now, here's what we're working on for Global Business tomorrow. We'll be talking to the outgoing president of the African Development Bank, Donald Kaberuka. After 10 years at the helm, what are his achievements? What does he think he could have done better? What does he think his successor should focus on? Also, we'll be looking at a looming fuel shortage in Nigeria, as the government apparently doesn't have enough money to pay for fuel subsidies. We've been here before, we're getting back there again. But all that and more will be coming in the next 23 hours, and that's it for this edition of Global Business. As always, we value your feedback, your thoughts and your ideas. Send them to globalbusinessafrica@cctv.com. As always, the news continues on Facebook and on Twitter. See you tomorrow. I'm Ramanya.